Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct. Today I am back at Moody's Analytics. Yesterday it was RBA. Today it's RBI as the Central Bank of India opted to cut rates for the third time this year. I spoke to Faraz Syed. Faraz, thank you so much for taking the time to chat with us today. A pleasure to have you on board.
Pleasure, thank you.
Okay, so the RBI sought to cut rates for the third time this year. This was a move which was largely expected, but can you walk us through really the thinking around the cut this time round?
Sure, I think it was quite similar to the previous rate cuts that we've seen the RBI do in the last in 2015 so far. So I think again the disinflation trend, India's disinflation trend was probably the main cause of the rate cut. We've seen inflation come down from its previous levels, largely due to lower oil prices, but also core inflation has been coming down, and that's been due to lower growth. We've seen industrial production fall in recent times, we've seen auto sales fall, and we've also seen capacity utilization at a lower level. Now, what this all means is the economy is most likely operating under a negative output gap. We saw in the March GDP report, although the growth was 7.5%, we still think India's potential is closer towards 9% or 10%. So given these couple of factors, we've seen the RBI keep an easing bias.
But still, even given that this isn't thought to be the last cut this year as part of this sort of loosening cycle that we're seeing, where are you continuing to see monetary policy heading?
That's a good question. I think it will largely depend on the upcoming monsoon season that India will have. So the monsoon season will go from July on to September. Now, what the Met Bureau is forecasting is for lower than average rainfalls in the coming months. Now, if that happens, what it leads to is higher food prices, higher prices for vegetables and fruits, and this tends to increase inflation. So if that scenario was to occur, we're unlikely to see the RBI cut interest rates again. But at the same time, given the negative output gap that I mentioned earlier, and given that US monetary policy normalization is unlikely to occur until later in the year, there's still a bit of room for the RBI to cut again, particularly so if the monsoon season is closer to average rainfalls.
Domestic demand has really been highlighted as key to growth for the Indian economy. 1 year into that Moody mania, is that weak domestic demand and also weak investment, is that a concern?
Yeah, I think the euphoria around Modi is starting to fade in recent times. Now, the large cause of that has been the failure to push some of those key reforms through. We saw the land acquisition bill fail to get through the upper house of parliament because the government doesn't have a majority there. That was a crucial bill because it would allow for easier infrastructure investment in India, and that failed to obviously pass through parliament. The other issue was the minimum alternative tax issue, the MAT that it's known as. So that also, in the previous history, the foreign companies weren't issued with the MAT, but we've seen over 100 issuance in the last couple of months. So there's a bit of uncertainty around that as well. That's led to a bit of deterioration in foreign sentiment. And again, the GST bill also failed to get through the upper house of parliament. So given these sort of three factors, or the failure to push some of the key reforms through, we've seen investors being a bit more cautious on India, and that's why we haven't seen a pickup in investment as we would have hoped.
The Indian rupee did fall against the greenback on this announcement, but has largely been rising against the US dollar. How is the RBI having to sort of factor this into its monetary policy decisions also?
Yeah, I think the recent commentary from the RBI suggests that they think the rupee is still higher than what they would actually like. At the same time, the reason for that is probably due to the global monetary easing. We've seen the yen and the euro come down, and as you mentioned, the US dollar has been quite stable. So given these factors, I think the RBA would prefer a lower currency, because what a higher currency would do for Indian exporters is it weigh on their external competitiveness. So I think while the RBI would prefer a lower currency, I think there's also a few challenges going ahead. Particularly if US monetary policy normalization starts to occur. But at the same time, I think we believe that India is well placed to handle that, because its foreign exchange reserves are quite high, and it's unlikely to go through the same taper tantrum that we saw in 2013.
Faraz, many thanks for your time. Look forward to catching up with you again soon. Thank you.
Thank you.
That is all we've got time for. Coming up this week on Sydney Direct with Dukascopy TV, we'll be chatting to the gentleman over at CMC Market, so do stay tuned for that. For now though, it's goodbye from me.